Hi, I'm Brian Babbitt, and I help lead the investment effort here at Financial Insights. As we all know, markets have experienced a pretty volatile beginning to this year, but I doubt the causes of this volatility will come as any surprise to you either. Thus far, two main factors have really influenced markets. Number one being Russia's invasion of Ukraine. The invasion has, of course, caused political instability, to say the least, but perhaps even more importantly, is that Russia is a major supplier of oil and natural gas to the world. And with economic sanctions kicking in now, we've already seen some impact on oil prices. And number two is the US economy, of course. With elevated inflation readings, and you combine that with the Fed removing its stimulus at the very same time, this has created uncertainty about short-term economic growth here in the US. And what we do know about markets is they don't like uncertainty. So as this volatility has taken hold and may continue, what should you do in response? Well, we have three key steps to recommend, and we plan to review materials in support of them now. Please keep in mind that these materials will also be available following this discussion. So number one is to put today's markets in context. A within-year pullback is actually quite common. Since 1980, market pullbacks have occurred in just about every single year, and they've averaged approximately 14% at that. However, it's also important to keep in mind that 32 of those 42 years in question did result in a positive return nonetheless. It's also important to remember that in recent years, markets have produced very attractive returns. For instance, between the beginning of 2019 through the end of last year, the S&P 500 has produced an average return of approximately 26%, which is quite attractive. So it's not surprising to see a pullback following this type of run-up. And finally, to put today's markets in context, it's important to review past geopolitical sell-offs and what happened. And the key takeaway here is that they were typically short-lived, followed by very attractive returns in almost every case. So if we look at the 1962 Cuban Missile Crisis, 2003 Iraq War, or even the 2006 Brexit vote, we saw a short-lived sell-off followed by very attractive returns, as illustrated in this chart. So getting back to our steps, number two is to stick to your plan and to resist the temptation to time the markets. During market downswings, it's a natural reaction to want to do something about it. But the best way to do something about it is to hold steady in the face of volatility. Going to cash or trying to time markets never seems to end well for just about everyone. And number three is to remain diversified in your portfolio. It's tempting to remove an asset that may not be holding up well in current circumstances, but we don't know when those circumstances might change and which assets may do the best. By remaining diversified, portfolios are better prepared for the unexpected. So with these three steps in mind, we have three illustrations to help reinforce each one of them following. And so the first is pullbacks in stocks are common. If we look at this chart, the blue dots are illustrating that pullbacks have occurred in just about every year since 1980. What you will notice is that the green bars actually match up with each of the blue dots. And what you'll notice is that there are many green bars illustrating a full year return as being positive and quite positive in some cases. So the key takeaway here is that pullbacks are common throughout the year and that there are plenty of opportunities for stocks to still produce a positive return. The second slide illustrates why it's important to resist the urge to time markets. If you had simply stayed invested since 2006, investing $10,000 would result in about $50,000 at the end of 2021. So there are plenty of events along the way that occurred, whether it be the collapse of Lehman Brothers, the June 2016 Brexit vote, or even more recently with the COVID-19 sell-off. You could have been tempted to sell out, but had you just remained in the market, you would have participated in the gains that followed. And finally, this slide illustrates why it's important to remain diversified. We simply don't know when markets will change and which assets will do the best under the new circumstances. By allocating to just about every asset that is located on this chart, you can be ensured that you will participate in the best performing asset in the next year to come. Thank you for listening. And if you have any questions, please do not hesitate to reach out.